I think you have to look beyond the Fed funds rate to the real rate of deterioration and real interest rates. If you looked at the 10-year Treasury rate, which I think is probably more important than the Fed funds rate, and you juxtapose that with the CPI stated rate of inflation, you would say that the real rate of return on a U.S. 10-year Treasury was 4.3 minus 2.6, which is to say that you were getting real yields in excess of 1%. I don't believe that the CPI accurately states the rate of inflation. If you define inflation as the deterioration in the purchasing power of real wages and real savings. When I look at the basket of goods and services that I consume, I believe that my purchasing power is deteriorating by about 7.5%. If you believe that to be the case, then the negative interest rate that you're suffering is closer to 3%. I think the juxtaposition of the CPI and my average is fairly easy to do. They hedonistically adjust the CPI, which is to say that they tell me what my computer is worth, irrespective of what I paid for it. And they don't include when it's inconvenient food or fuel, which is difficult for me because I like to eat. But my greatest criticism is that it doesn't include tax. Now, not defining tax as a good or a service is certainly something I understand, but it makes it difficult to use it to quantify my cost of living. So I would suggest that what you saw in the period of the 70s was a period of increasing nominal interest rates, and until the end of the decade of the 70s, a period of decreasing real interest rates. The nominal interest rate, as expressed by the U.S. 10-year Treasury, would have been a 7 or an 8 or finally a 15, but the rate of inflation was consistently between 12 and 15%, which is to say the real interest rates were negative. After the Volcker-Reagan experiments, largely successful in my view, in the early part of the decade of the 1980s, we experienced a 40-year benign period with declining real and nominal interest rates, with the hegemony of the U.S. dollar, which allowed us to export our political idiocy and our inflation to other people. A wonderful set of circumstances. My belief is that that trend line was probably broken 2000, 2001, 2002, and we're back into a period of negative real, if not nominal, interest rates, and hence the interest in gold.
To understand the value of gold and silver, we must look beyond surface-level metrics like the federal funds rate. Instead, we should focus on real interest rates and the actual rate of economic deterioration. Rick Rule suggests that the 10-year Treasury rate is more significant than the federal funds rate. When you compare it with the Consumer Price Index, CPI rate of inflation, the real rate of return on a U.S. 10-year Treasury is the difference between these two figures. If you take a 10-year Treasury rate of 4.3% and subtract the stated CPI inflation rate of 2.6%, you get a real yield of about 1.7%. However, I believe the CPI doesn't accurately reflect the true rate of inflation. If we consider inflation as the decline in purchasing power of real wages and savings, my experience suggests it's closer to 7.5%. This means the real negative interest rate is around 3%, which is quite alarming. Rick raises a crucial point about the CPI. It is often hedonistically adjusted, meaning it accounts for perceived improvements in quality rather than just price changes. For example, they might tell us that a new computer is worth more than we paid for it, and they exclude volatile essentials like food and fuel. These adjustments can mask the true cost of living increases. This discrepancy becomes evident when comparing the 1970s to today. Back then, we saw rising nominal interest rates but declining real interest rates. High inflation rates meant real yields were negative. After Paul Volcker and Ronald Reagan's policies in the early 1980s, we entered a period of declining real and nominal interest rates, with the U.S. dollar maintaining its hegemony. That period allowed the U.S. to export its inflation and political issues abroad. But I believe this trend broke around the early 2000s, bringing us back to an era of negative real interest rates. This scenario makes gold particularly attractive. Let's delve into why gold becomes appealing in such times. When Social Security was enacted, it provided a poverty-level existence for retirees starting at age 65. Back then, The average life expectancy for an American male was 66 years. Today, it's 84 years, meaning Social Security needs a serious overhaul. We might need to means test benefits or push back the vesting age, which are politically sensitive but mathematically necessary solutions. Our response to these challenges often involves devaluing benefits through inflation. Looking back at the 1970s, the solution was to debase the purchasing power of the dollar by 80%. If you held gold or silver during that decade, your purchasing power increased. In the year 2000, gold was priced at around $256 an ounce. Today, it's over $2,400. This represents an increase of almost tenfold, or an 8.4% annual compound rate over 25 years, outpacing inflation. While societal challenges might seem insurmountable, personally, you can protect your purchasing power by investing in precious metals. J.P. Morgan Chase reports that precious metals make up only 0.5% of total savings in investment assets in the U.S. Yet historically, this share was around 2%. A reversion to the mean would imply a fourfold increase in demand. Rick's insights highlight a compelling case for gold and silver. Despite the challenges faced by society, individual investors can find refuge in these timeless assets. Gold and silver have consistently preserved wealth, especially during periods of economic uncertainty. In Part 2, we'll explore practical steps to start investing in gold and silver, the potential risks involved, and how to balance these investments within a diversified portfolio.
When Social Security was enacted, it provided poverty-level existence for people beginning at age 65, and the average life expectancy of an American male at that point in time was 66 years. Now it's 84 years. So likely we will end up having to means test Social Security, which is to say to upper income taxpayers like myself, yes, you put in way more than you're going to get. Too bad, so sad, that's what's going to happen. We could change the vesting years from what has now fallen to 62 back up to some number like 80 over time. Ugly, ugly, ugly political circumstance, but not dealing with it implies no facility with arithmetic, no facility with facts. I bring all this up in the consequence of a gold and silver discussion, because when you look at the way that we as a society deal with this, rather than attacking the problem, what we do is we devalue the benefit. If you look at the last time we faced this circumstance, that was in the decade of the 1970s. And we faced the circumstance, or rather the solution to the problem that we faced, was debasing the purchasing power of the dollar by 80%. Robert Friedland says it's not serious if during the decade of the 1970s you personally were a gold holder or a silver holder, your purchasing power went up, not down. Similarly, in the period 2000 until today, many people say, Rick, when's the gold price going to move? I say, I think in the year 2000. In 2000, gold was $256 an ounce. Today it's 24 something. Gold price is up almost tenfold. It's increased at 8.5% compounded 25 years, more than kept pace with inflation. So while the situation is hopeless from the point of view of society continuing as it is today, for you personally, for your listeners, the situation doesn't need to be as serious. J.P. Morgan Chase published a study suggesting that the market share of precious metals and precious metals-related investments comprises about 0.5% of total savings and investment assets in the United States, which is to say it's as irrelevant as a pimple on an elephant's behind. J.P. Morgan Chase also pointed out the statistics suggest that the 4-decade mean market share of precious metals and precious metals-related investments is 2%. So if we merely have reversion to mean, demand for the stuff grows fourfold. That's what I think is going to happen. I'm not one of those who suggests that the U.S. dollar is going to go the way of the dodo. I'm not one who suggests that gold will eclipse U.S. Treasury securities as savings instruments. I just think they'll lose less badly, precisely because the market share, even the mine share of gold, relative to other investments is infinitesimal. Now, of course, I came of age as an investor in the decade of the 70s, and gold was everywhere in the investor mindset. It is estimated, although no statistics exist, it is estimated by J.P. Morgan Chase that the market share of precious metals and precious metals-related investments in the United States in 1980, 1981 crested at 6 or 7% compared to 0.5% today. So as I say, if your friend, your professional investor or your active investor, was to consider reversion to mean as an investment characteristic, he might tend to look more favorably at gold.
In part 1, we discussed the underlying value of these precious metals and why they remain a crucial part of an investment strategy, especially during economic uncertainty. Now let's talk about how you can start investing in gold and silver, understand the risks, and integrate these investments into your broader financial plan. First, let's explore the different ways you can invest in gold and silver. The most straightforward method is purchasing physical bullion, bars and coins. This tangible asset can be stored in a safe deposit box or a secure home safe. Popular choices include American Gold Eagles, Canadian Maple Leafs, and South African Krugerrands for gold, and Silver Eagles and Maple Leafs for silver. While owning physical bullion is reassuring, it does come with storage and insurance costs. Another option is investing in exchange-traded funds, our current ETFs, that track the price of gold and silver. These ETFs, like SPDR Gold Shares, GLD, and iShares Silver Trust, SLV, offer liquidity and convenience, allowing you to buy and sell shares on the stock exchange. Mining stocks are another way to gain exposure to precious metals. By investing in companies that produce gold and silver, you can benefit from potential price increases of the metals and the company's profitability. However, this also means taking on additional risks related to the company's management and operations. For those looking for a more diversified approach, consider mutual funds or ETFs that invest in a basket of mining stocks. Examples include the VanEck Vectors Gold Miners ETF, GDX, and the iShares MSCI Global Silver Miners ETF, SLVP. These funds spread the risk across multiple companies, reducing the impact of any single company's performance on your investment. Now let's address the risks associated with investing in gold and silver. While these metals are known for preserving value, they are not immune to market fluctuations. Prices can be volatile, influenced by factors like geopolitical events, economic data, and changes in interest rates. Investors should be aware that while gold and silver can protect against inflation and economic instability, they do not generate income. Unlike stocks or bonds, these metals don't pay dividends or interest. Therefore, they should be considered a part of a diversified portfolio rather than the sole investment. Speaking of diversification, it's essential to balance your investments across different asset classes. While gold and silver can hedge against inflation and currency devaluation, stocks, bonds, and real estate can provide growth and income. A well-rounded portfolio can help mitigate risks and achieve long-term financial goals. Consulting with a financial advisor can be beneficial when integrating precious metals into your portfolio. They can provide personalized advice based on your financial situation, risk tolerance, and investment goals. It's also crucial to stay informed about market trends and economic indicators. Resources like financial news websites, investment newsletters, and reputable analysts can provide valuable insights. Remember, knowledge is power in the world of investing. Let's address some common questions about gold and silver investments. One frequently asked question is, how much of my portfolio should be allocated to precious metals? While there's no one-size-fits-all answer, many experts suggest allocating between 5% to 10% of your portfolio to gold and silver. This allocation can provide a hedge against inflation and economic downturns without exposing you to excessive risk. Another question we often hear is, should I buy gold or silver? Both metals have their unique advantages. Gold is typically viewed as a more stable store of value and is often preferred during periods of high inflation and economic uncertainty. Silver, on the other hand, has more industrial uses, making it potentially more volatile, but also offering higher upside potential during periods of economic growth. Consider your investment goals and market outlook when deciding between gold and silver. Some investors choose to hold both to diversify within the precious metals category. Finally, let's discuss the potential future outlook for gold and silver. While predicting exact prices is challenging, several factors suggest a favorable environment for these metals. Ongoing geopolitical tensions, rising national debt levels, and potential inflationary pressures are all catalysts that could drive demand for gold and silver. Moreover, central banks around the world have been increasing their gold reserves, indicating a growing recognition of its value as a monetary asset. According to the World Gold Council, central banks purchased a record amount of gold in recent years, reflecting concerns about global economic stability. The low current market share of precious metals in investment portfolios also suggests room for growth. As more investors seek to diversify and protect their wealth, demand for gold and silver is likely to increase. In conclusion, investing in gold and silver offers a way to preserve wealth and hedge against economic uncertainties. While these investments come with risks, their historical performance and enduring value make them a valuable addition to a diversified portfolio. Thank you for joining us on this exploration of gold and silver. We hope you found this information valuable and insightful. Remember to like, subscribe, and hit the notification bell for more in-depth financial insights and investment strategies. Until next time, happy investing.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.